welcome back to the Monthly Income Podcast. I'm Tom Lydon, and as always, I'm joined by the founders of NEOS, Garrett Paolella and Troy Cates. Gentlemen, how are you? Good to see you.
Great to see you guys.
Good to see you, Tom.
Yeah, good. Hey, thank you for getting us through tax season. It's not always easy. On the last podcast, we tackled a few of the tax issues. Garrett, notably 19A1, return of capital, how year-end reporting works. When you're making money, it sometimes requires a little bit more work, a little bit more knowledge, right?
It can, right? We try to keep it simple, but always try to think about ways to be as tax efficient as possible regarding, each one of the funds, we manage. But to the extent there can be questions sometimes, there can be more unique things that as these products have become more popular, with investors, both US and abroad, there can tend to be questions on how that relates to their own individual, tax situation and how things can get structured. So it's always good to try to get as much information as possible, but certainly always loop in your financial advisor or tax planning, professional, because that's really to make sure things are covered the correct way. Don't always try to go out, on your own with it.
Yeah, no, you're right. And Troy, all the webcasts we do, the podcasts we do, you always talk about how not all options-based ETF strategies are created equal, but you dug deeper in the last one talking about the tax efficiencies, and that's really key. I think people understand it better.
Yeah, I think it's important to understand that when you're investing in these products, because at the end of the year, you're going to get a 1099, as we talked about on the last podcast, and you're going to find out how much you potentially owe in taxes from your investments, from the distributions you receive from the NEOS products. So it's important to understand that if you have similar type products, some of our competitors have NASDAQ 100 products, S&P 500 products that provide income as well. It's important to understand the differences and what that'll look like on a net after tax basis. And so I know we walked through some of that, but it's really important to understand that, because at the end of the year, when you get that 1099, you're going to have to pay taxes. And it's how much do you keep and defer taxes, or how much are you paying out currently? So it's something to think about as you're looking at all these products.
One thing that's been great about all the podcasts you guys have been on and the feedback we've been getting from investors is great questions have come to the surface. Another big question has come up about NAV erosion. So today we're going to talk about NAV erosion. We're going to break it down. Actually, what does it mean, why it matters, and how it relates to options-based ETFs. And Garrett, maybe you can get us started. First of all, what is NAV erosion? What does NAV stand for? And specifically define what that NAV erosion is.
This question, I think, is becoming up more frequently, but it's a great concept for investors to understand. NAV means net asset value, right? It's the total value of the fund's assets that it holds between the cash, either equities, fixed income, options. So it is the total net asset value, so the total fund value. NAV erosion is a concept that comes up in products that have, higher distribution rates or income, potential. And that could be in option-based strategies. It could be in just regular traditional-based products. NAV erosion ultimately is talking about the level of the net asset value. So think a share price. Let's just, for example, so we could walk through it, $50 a share, right? You bought an ETF that IPO'd or launched at $50 a share, and it's making money along the way, but ultimately your NAV, that net asset value, that share price, maybe is down to $45 from $50. NAV erosion is more of a negative issue within the fund, where the distributions are greater than what the fund is making. And I think we really need to unpack this. And I think between me and Troy and over the next couple of minutes, because there's a big difference between just having the value of the underlying securities down for a period of time, right? That's just participating in the exposure that the fund has, versus a NAV erosion that is essentially distributing more than the fund is making. So I think that's a simple way, and I think we can unpack it, over a series of a couple of questions here, because it's a really good concept for people to understand.
Yeah. So Troy, using Garrett's illustration, for example, you have a net asset value of $50 and it goes down to 45. So 10% decline. And let's just say that the market's been flat. Walk us through, if you would, if there were a distribution of like 12%, would that in fact be right? Maybe go through that a little bit deeper.
Yeah, so when you're thinking about it, it's really what causes NAV erosion, as Garrett was going through. It's really over distributing the income or premium you're receiving. So and you think about covered call funds, you think about that $50 net asset value at start. If the fund sells a call and brings in $1 of premium, It still has that liability on the book, but say it takes that dollar premium and distributes it out, the share price is still at $50. That is not NAV erosion. You're just distributing out the premium you received. If the fund takes in a dollar premium scenario two and distributes out $3 in premium and basically eats into the underlying reference assets NAV, maybe has to sell some shares or eats through some cash and distributes out $3 versus the $1 it brought in, that would be defined as NAV erosion. That's over distributing. You're not bringing in enough premium to have that large of a distribution. Whereas Garrett was talking about, you might have the market selling off, the underlying reference, say the S&P 500, the NASDAQ 100 is selling off and moving lower. So you're participating with that, but maybe you're still bringing in premium that you're distributing out. As long as you're not distributing more than that premium you're bringing in from those, say, short calls, that is not NAV erosion, although the price might be lower at some point. So I think it's really important for people to understand that, because we'll use SPYI as the example. That fund distributes right around 12% annualized. That's about a 1% a month distribution. If suddenly that fund was able to bring in only 30 basis points one month and we still distributed 1%, that would be considered NAV erosion. That's not what we're doing in the NEOS funds, but you might have a month, particularly like this year, or a number of months where the market is selling off and we're still bringing in that 1% or so and distributing that out, but you're participating with the underlying equities that are moving lower.
We're going to go a little bit deeper into how Neos does it specifically, but addressing the elephant in the room, there are a lot of products that are in this space. It's exploded. The amount of money that's in the options overlay or synthetic income space has exploded. Just from a competitive standpoint, there are issuers out there that have been fairly aggressive, promoting pretty high distributions. So when we think about this, and obviously that high distribution level is going to attract assets, but it also requires education, and you have to know how that's affecting your investments personally. Maybe walk into that and just some warning signs that investors should consider.
Yeah, I think we are very big proponents of doing your homework and doing your research within any place that you're going to put your hard-earned money. And I think one of those areas is if you start to see a distribution yield in a product that is, vastly higher than other products within that same exposure, or just seems very high to yourself, take a look under the hood, understand what it is that the fund is ultimately doing, what exposures does it have, right? Because a distribution rate in the sense of a 25 to 30% for Bitcoin can be reasonable, right? A distribution rate in the what we've seen sometimes 70, 80, 90, 100% in the NASDAQ 100 or S&P, right? That should give you some type of a red flag. Oh, how am I earning 100% of my money in a 1-year period owning the S&P 500? So I think at the end of the day, it really comes down to one, doing your homework, understanding the space and the products that you're going to ultimately invest in, but then bringing that back to your own estate planning goals and your risk tolerances, right? At the end of the day, it's only you know or fully understand your financial risk profile, income needs, goals towards retirement, and stay strapped to those, not somebody else's bringing up a 100% distribution rate product to you saying this is a great investment. I'm earning, 8% or more a month, on my investment. So it's definitely do your research, do your homework, and make sure you're feeling very comfortable within the product, that you're investing in, especially relative to others that have a high degree of correlation.
Troy, for years we've heard about investors should be very careful about chasing equity market returns. Now, with this proliferation of enhanced income strategies, are we in a situation where there may be investors who are chasing yield and making mistakes in that area?
Yeah, I think, as we at least try to do our part in the education piece of it, we've definitely talked to advisors who might just source by yield and say, all right, I want to look at, as Garrett was walking through, NASDAQ 100 funds with the highest distribution rates. And they'll come across the ones that are 90%, 75%. And maybe we're further down the list because our QQQI distributes, in the 14% range on an annualized basis. So I think what's really important as people look at this space is to really not so much look at the distribution yield, but look at the total return and understand that that includes the distribution. So you could take it all into effect. And that's when you could really stack those funds next to each other and say, okay, now I understand this one might have 100% distribution and this one has a 14% distribution, but what's the total return look like from each of them? And what is the potential, as we were talking about earlier, the NAV erosion on the one with the higher distribution. So it's important to understand that and really do your homework and go through these. And I think it's more important now than it's ever been because so many funds are coming out to the marketplace all within the same sector, and everybody seems to offer a different angle or tilt on what they're doing in their option strategy and what that looks like to each investor.
Great advice. All right, let's talk about NEOs and specifically how you folks do it. Garrett, talk about your differentiated strategy, if you would.
Sure. So I think, as maybe some of the audience knows, we have a lot of different products across different strategies, equities, fixed income alternatives, and some of those are using, the call option side, some are using put options. But I think keep it simple about how we've been discussing more as an example, covered calls in NAV erosion today. What NEOS is really focusing on is dynamically resetting our portfolio on a monthly basis. And so we're looking at several factors in the market for that reference asset. If we use the S&P 500 as an example, looking at factors and returns of the S&P 500 and then the options market of the S&P 500. And what it's allowing us to do is reset our portfolio on a monthly basis to really try to deliver the highest level of probability to meet the investment objective of that fund. And so those factors and all that research comes into a rules-based strategy. And so we have a set level of rules that we're following to guide us on a continuous basis and not an active management where that's just done on discretion and feeling and what's going on in the market. And so when we think about returns and distributions, think just like estate planning. And the way that works is when you're looking at your estate plan, you have growth investments, you have conservative investments, you have income investments. And if you need to live off that money, you want to always pull any type of capital you need from a positive part of your portfolio. So we're seeking to deliver that through the thought of a covered call where you're long equities, you're selling covered calls. And that essentially is a short part of the market. And what that ultimately is if you think about in a very positive equity market, you have your equity gains. And your equity gains can be your NAV appreciation plus a function of part of the distribution, along with just dividends that you're receiving from the underlying. In a slightly higher market, flat or down, you're going to have your equity dividends, but then you're going to have the options premium to be able to meet that distribution. So if you think market's up, you have a positive part of your P&L, which is your equities. Market is maybe slightly higher, flat, or down. You'll have unrealized losses in your equities, but you have options premium that you've earned to meet that distribution. So as we think about it, we're always looking to pull from a positive part of the portfolio to meet those month over month distribution rates. And that's how we look to structure a lot of our products for that kind of consistency, reasonable distribution rate that can be met through various market cycles, volatility levels, but also as you think about that very short-term month-over-month distribution that needs to be sent out to investors, sourcing that from a positive part of the overall portfolio.
Excellent. Troy, you kind of touched on it earlier. You have targeted returns, distribution returns for each ETF every month. And every month it starts from scratch. It's a new game every month. There's no guarantee that you can always hit those levels, but that's the challenge every month. Kind of walk us through that and what that means, especially for the dividend that's received.
So for each fund, as you said, when we're building these funds, way before we even write a prospectus, we're doing a lot of testing. We're understanding what the liquidity is around the options market for these funds. We're understanding how certain option strategies might interact when you put them together with the underlying reference asset and what that might look like from an income perspective, what kind of premium we're receiving on a monthly basis. So we test these funds and we build out the rules around each strategy. And then when we're building out the rules, we want to have a target distribution, not only so we could talk about what the target distribution is, because that's what the fund is aiming to do. It's not always guaranteed, as you said, but it's aiming, for example, SPYI to be in the 10 to 12% distribution range on an annualized basis. So when the fund is looking at its rules as it's rolling, as you said, every month is different. When we're rolling those options at the end of the month, meaning we're closing out the old short calls that we had in the portfolio and putting on new short call positions. Our model and rules are looking at certain factors around volatility. And given where volatility's been the past couple of months, obviously a little bit more elevated than we've seen towards the end of the year versus where it is now at the end of Q1, it's important for us and to follow those rules and then to see what is that distribution going to look like? How far out of the money do the calls need to be written on? How much of the notional is going to be written? And that's all in the rules. And when that premium comes in and we know, okay, we have enough to distribute, say 1% in SPYI, for example, that's important to fall within that range. And yes, in heightened periods of volatility, we could bring in more premium. But the way we have designed the rules around it, we want to make sure that if the market does turn around and move higher, that these products can participate on the upside and capture a good portion of the upside with the underlying reference asset move. So we want to make sure that we're not covering 100% of the notional as maybe some of the older products that are index based do. We want to make sure we're writing further out of the money if possible per the rules based strategy. So it's really important for us. And every month is a little different because volatility changes day to day.
Kind of what you're saying there is there's some months where there's greater volatility and it might be easier for you because you folks thrive with volatility to be able to get that income easier or quicker. But you make it in the discipline and in the strategy. You're not going for twice that distribution. You're looking to make sure that you're participating more in the realistic underlying of the marketplace. Is that right?
Yes, we're trying to capture as much of the upside of the underlying reference asset, in this case, the S&P 500 that we keep going back to, while still bringing in enough premium to have that distribution on a monthly basis. We're trying to hit that distribution target range on a monthly basis so the fund can also continue to grow and hit its distribution
Yeah.
targets.
Garrett, I think that aligns with the next question, which is how do you think about balancing the distribution rate along with long-term capital preservation? That's really important to shareholders.
Yeah, so I think, as Troy was kind of mentioning, right, as we think about the rules and a lot of the testing and the research that we do, what is the opportunity for us to be able to harvest that volatility in the options market, generate kind of that targeted distribution rate in low vol, medium volatility, and high volatility times while having that upside appreciation? And the way we look at that is we're assessing what is the annualized performance of the S&P 500, what is the options market saying, and so you're marrying the two of those within the research and ultimately the rules to be having both of those have be a contribution into the fund. It can't just be all about current income generation because you'd have no upside appreciation. And it can't just be 100% upside appreciation and tracking of the index because you're not generating then any income in those months where the market isn't up greater than, say, 1 or 2%. And so it's really finding the balance between the two through research and really historical returns to come up with the rules that say, okay, I'll be able to generate a consistent level of a distribution. And by the way, the rest of the portfolio doesn't need options on it. So it can have appreciation to track those, off months where you have, obviously a 3, 4 standard deviation move to the upside to where the S&P might be up 10% in a month versus maybe it's normal 2 to 3%.
Troy, you mentioned in the building process, as you create more products, you do an assessment of what that distribution level might be. How do you evaluate whether the distribution levels are sustainable over the long term?
Yeah, so when we're doing that testing, we're looking back through many different market cycles. We're looking back and seeing how would this potentially have performed in really rough down markets and up markets when volatility is low, when volatility is high, and understand what that could mean for each portfolio. So as we build out those distribution ranges, we know that through different market cycles, we could source that premium from the options market, whether volatility is very low or whether volatility is much higher. As we build each one, each product is a little different. Each distribution range is definitely different because those underlying reference assets and the volatility versus the S&P is different than the NASDAQ or Bitcoin or Ethereum and so forth. So it's very specific to each fund as we think about how each one's going to do.
Garrett, there's been a lot going on in the market this year. Things don't seem to be ho hum. There's a lot of news out there, the volatility and gas prices. How has Neos performed relative to expectations?
Well, listen, in our opinion, our funds have delivered exactly what we have set out to do for them. And I think as we think about that relative to our investment process, it's what it's meant to do. I think we're very, happy with the overall performance and how the funds have performed. And each fund again is different, right? Some of our products are actually up this year. Some are up significantly. Some, have some negative performance. So I think it depends if you're looking at equities versus alternatives like real estate, gold, commodities like energy and infrastructure, fixed income. And so because we have a diverse lineup for letting investors espouse their views, I think as we see market volatility, turbulence, markets that could be down, markets that can be up significantly today, we're very pleased with the performance and the funds are all in line with, our expectations.
Troy, you talked about volatility and how it works. Obviously, there's been more volatility. Has that made it easier for you to get that monthly distribution level in some of the products?
Well, I never say it's easy, Tom,
Yeah.
but I think when you think about bringing in premium, yes, when volatility is a little higher, it can be a little easier to source that premium on a monthly basis. But it really, as we kind of walked through earlier, we're following these rules in our strategies, and it gives the portfolio an opportunity to potentially sell calls further out of the money and on less of the notional, which if we do have that reversal and the market stops grinding lower here, or something changes geopolitically and the market does want to move higher, the equity markets want to move higher, it could participate with those markets as they move higher. So for us, yes, volatility is not something we shy away from. It's important to make sure some of our products, our fixed income products, roll on a weekly basis because we want to try to harness that volatility in certain scenarios, whereas some of our other products roll on a monthly basis. So it's important to understand how each product works and how volatility might affect each product.
Garrett, you and Troy are talking to advisors all the time. Obviously, there's been a lot to talk about, and I know you've been busy. You spend most of your day talking to advisors. Also, monitoring the amount of money that's been flowing into NEOS ETFs. It hasn't slowed down either, even though there's been volatility in the marketplace. How are advisors who are utilizing NEOS ETFs positioning today?
So I think we spend a lot of time on diversification, right? Diversification, durability, right? And so as you think about it, we intentionally have our product lineup built across, as we talk about the big core buckets, equities, fixed income, and alternatives. But you could ultimately go and choose a product with us that has 1 to 3 month treasury bills in it on the much lower risk end of the spectrum, or you can get all the way up into our boosted Bitcoin series where you're taking a levered exposure to crypto. And so in between everything that we have there, from the lowest risk to the highest risk, it's around building a portfolio that meets that end investors estate planning goals, risk tolerances, cash flow needs, and how can you leverage several of our products across the portfolio to maintain the exposure that either the advisor is setting and recommending or that the client is looking for within their risk allocation bucket, but generating that more tax efficient income. And so I think that's where we spend a lot more time, is like, how do our equity products fit within your equity allocation? How does your fixed income fit within the client's fixed income current allocation? Or how can they layer in alternatives where they have alternatives, or potentially where they haven't before, as another diversifier in their portfolio? I mean, if we think about just simply gold, energy this year, right? Those are the ones with positive performance, overall, not speaking NEOS products, just in general, those asset classes. And so there's been a lot more conversations of, if the markets aren't going to go up 25% a year like we've seen for the last few years, how do I think about diversification and consistency of returns or income for my client? And if you can do that on a more tax efficient basis or with some higher levels of distributions, it helps them achieve that cash flow they need and maybe potentially weather more short-term shocks in the market for geopolitical reasons or tweets that get put out there and drastically change the way we think about the world, and stuff. And so I think that's been more the conversations today about asset allocation and what investors are thinking.
You folks have not slowed down as far as new product. I know you're listening to investors, you're listening to advisors all the time for input. You've developed this new boosted suite. You've enhanced your hedged and high income suite. How does that all work into the long-term plan as far as helping out advisors and investors?
As we kind of walked through earlier, the long-term plan is to continue to be a solutions provider, continue to offer, whether it's in the alternatives, whether it's more high income, whether it's something to add to the boosted series or fixed income, continue to offer different solutions that will help advisors and investors allocate their money towards whatever sector they want to in the market. And we've talked about it before. We started with 3 ETFs in August of 22, and here we are at 19, but still with the same idea of continuing to slice up that asset allocation pie and offer more and more different solutions for people to invest in. So when they think about income, when they think about sourcing income from an option strategy, they think about NEOS and come and hopefully can find a product that fits their needs.
All right, guys. Well, this has been great. One of the best ones yet. And again, I want to thank all the listeners and viewers to sending in your questions. Don't hold back, because this is what feeds the podcast. And we're looking forward to having you next month on the Monthly Income Podcast. Troy, Garrett, thanks, guys. We'll see you soon.
Thanks, guys.
Thanks.